Hi, Amisha.
Hi, good afternoon.
Good afternoon.
How are you doing?
Great, great. Busy day. One thing to the next. Here we are.
I swear. Thank you so much for your time.
Hmm. Yeah. Likewise. No, happy to chat and always interested. I saw we're going to do something about the trade war. But
Exactly.
yeah, but we can talk however you want to frame it as what the topics are. I could use a few slides if you think it's helpful, but otherwise
Yeah,
I'm
that'll
also
be
happy.
helpful. I saw one of your videos, which was about can China save the world? I don't know if you want to refer to some slides from there, but you are free. Um, that would be helpful
Um,
also. But we will
yeah.
revolve around trade war, China's reaction, its impact on global growth, global currencies, global commodities, and global markets. Something around that we will weave the whole conversation. And of course, get your views on that.
Okay, great. Well, yeah, I can talk certainly about the green stuff. That's not hard. But yeah, I think there's some value in kind of stepping back to start with around what drives the Chinese economy these days, and
Correct. Absolutely. It'll be
sort of
good insight, very good insight. You need screen
okay.
share, right? You have it?
Yeah, if you can, that'll make it easier to show this. So
Hi, Jeetu. How are you? You are on a mute. Dimple, please tell them Lola wants screen share rights.
Hi,
Just
Misha.
organize. Hi, Jitu. How are
Good to
you?
see you. Very well. How are you?
Very good. Lola, let me introduce you my co-panelist, Jeetu
mhm,
Panjabi. Jeetu had been heading Capital's global strategy. And of
mm,
course, now, like you, he also has his own firm.
mhm.
And he's been watching, observing, and having deep insights into the new economic order which is about to come in. So we thought it will be lovely to have him also co-host and ask a few questions.
Hi, Lola. Nice to meet you.
Pleasure. Yeah, likewise. Always good to have colleagues on the phone. We can exchange views. It'll be fun.
Absolutely. Are you based in Shanghai or where are you? Where are you now?
Yeah, I'm in my office here at New York University in Shanghai. So
Okay.
I embody U.S.-China collaboration right now.
Wow. Wow. I've spent a lot of time in China. I'm going to
Oh,
be there in 2 weeks as well, but good to meet you for now.
great. Well, maybe we can have a tea or something when you're here. It'd
I
be
will
nice.
I will get in touch.
Great.
So it's almost 1:32, and I think it's good to start our official discussion. But once you check, did you get the rights?
Um, yeah, I believe so. I can do this. Yes,
Correct. So
I
you
can.
can start.
Okay. All right. Well, let me first of all thank the colleagues for making this opportunity available, and I'm curious as to what happened to my chart.
Okay.
The, uh, Hang on, I'm getting there.
And by that time, let me officially introduce you to all the viewers also. Okay.
hmm, yep.
So, good afternoon, everyone. We are facing a situation where a world remade by tariffs is unleashing. We are seeing US China trade war has escalated into the most far reaching rupture in global trade architecture. As of April 25, most of us we know, but US has imposed a 145% tariff on most Chinese imports, citing economic coercion, overcapacity, or strategic dependency. In response, China has levied retaliatory tariffs of 125% on wide array of US goods, effectively freezing bilateral trade flows. Trade flow data confirms that container volumes from China to the US are down 45% YOY, and almost 30% of outbound China sailings are cancelled. Tech and electronic trade has slowed sharply, particularly in semiconductors, EVs, and critical inputs. Southeast Asia is witnessing opportunistic diversion, but this cannot offset the structural loss in bilateral trade volumes. While we all are talking about it, a few data shows something else. Contrary to market perception, China's direct dependence on US economy is very limited. Total export comprise of 18% of China's GDP, below most ASEAN and EU economies. Exports to the US account for only 2.6% of China's GDP. While the bilateral trade surplus contributes almost 1.5% to national output, these figures, we believe, are giving a lot of confidence to Beijing, whereby their counter strategy is very disciplined and also escalating. Alongside retaliatory tariffs, it has restricted strategic exports of gallium, graphite, API, and accelerated domestic substitution. Above all, China has not assented to any negotiations on tariff war. And at this juncture, we cannot have a better guest than Dr. Lola Woetzel, who has been a foremost global expert on China's economic transformation, trade policy, and geopolitical shifts reshaping the global economy. Based in China since 1985, she co-founded McKinsey's China practice and went on to become a Senior Partner Emerita of the McKinsey Global Institute, the firm's flagship economic research arm, where she served clients at the highest level of government and Fortune 500 companies. Dr. Woetzel currently serves as a visiting professor to Global China Studies and Business at NYU Shanghai. She has also authored numerous books on China and global macroeconomic disruptions. She now leads Global 6, a newly launched global advisory and execution platform for large-scale urban development and economic empowerment projects. And I believe and I understand that she's been also consulting for Amravati, one of the states in India, which is under one of the very dynamic leader. I'm also joined today as co-host by my very dear friend and of course an extremely respected market participant, Mr. Jeetu Panjabi. He's an engineer from Mumbai University, and Jeetu, very happy to know that you've done your MBA from Sri Satya Sai Institute of Higher Learnings. He has spent 20 years with the 2.7 trillion capital group from LA. His last role in the company was Global Equity Strategist, Asia Macro Head, and India Office Head. So he brings absolutely the wealth of experience that we need for today's discussion. He's based in Mumbai and now runs his boutique firm called EM Capital Advisors. He's currently advising some foreign investors, large family offices on strategic business issues and investing in India. So let me start today's session with the first question. From your vantage point, Dr. Lola, how should we interpret this, which I just described, US and China's stance on trade war?
Thank you, Amisha, for that very kind intro. And yes, I have had the pleasure of spending working time in India in the past, including in Telangana and with His Excellency Chandrababu Naidu, as well as on the other side of the country in Gandhinagar and Gujarat. So I'm a deep appreciation for the journey that the Indian economy is on. And I see it through this lens of urban development, where it's, I think, necessary. It's a fundamental part of the modernization process, and it changes us not only economically, but physically and socially and in so many ways. So I will be happy to bend your ear about that. But let's focus on the thing that we're doing today, which is the this current conflagration. So a few years ago, Kishore Mahbubani, maybe some folks know, who was a professor at the National University of Singapore. He had a foreign ministry role for a while there. Anyway, he wrote a fun book called "America's Having a Hard Time Being Number Two." And this was, I think, almost like 7 or 8 years ago now. And yeah, in a nutshell, that's what's happening. Is that, well, I would say that it's not actually even that much about China. It's much more about what's going on inside the U.S. economy and the need to find, people responsible for it. So, you have to point the finger at somebody. And so China is a fairly straightforward target for the stagnation of the American economy, the decline in quality of life, the stagnation and, in fact, plateauing or decline in life expectancy. There are a lot of issues in the United States economy, and you have to blame it on someone. So yeah, Chinese people don't vote. So that is, I think, the genesis of this. Now, does beating up on China solve the problem? No, at least not directly, unless you actually do something about it. So the real question will be, what does the US do to replace China? So in the event that we actually see, investments, fixed assets coming into the ground in the US with attractive economics to sustain that, that's the killer question. Do you see that? And if so, where? And honestly, from a political standpoint, you're getting mixed messages. Because on the one hand, the tariffs are going up. On the other hand, we think that investing in semiconductors in the US is a bad idea. And instead, we should be having large people with big fingers screwing in iPhones. It's like, no, this is not the way. And so, no, we're getting very mixed messages here. Now, the US is a big place. Let's see what happens. I mean, I think there are voices that say we should have more investment in the US, and we should in fact have Chinese people investing in the US. And if we look at some deals like CATL and Ford, that's an avenue. And so frankly, it would take a very brave Chinese investor to go to the US right now, because who knows, maybe Sarah Huckabee will take your land or something like that. It's not a reliable partner anymore. But there are still places and industries where we, think there can be opportunities. So let's see. That's on the U.S. side. It's sort of this visceral reaction to the reality of American economy stagnating, which is again due to domestic factors, and we skip over that for the moment. So on the China side, China saw this coming. So about 15 years ago, I remember listening to, I think it was Li Keqiang, saying something about how, or maybe it's Wen Jiabao, saying like, China has to move away from its unbalanced development model, and sort of like there's just too much dependence on all of this. The era of trade as a growth lever for the economy is kind of coming to an end, and we have to rebalance towards domestic consumption. So then we had the dual economy goal. And then there was the whole like, well, okay, fine. So if the US isn't a trade market, what is? And therefore Belt and Road. So, I mean, and this has coincided with what is colloquially called the rise of the rest, which parenthetically I will say includes India. But it's the reality that the US is a much less relevant market for the world, let alone for China. Than it was 10, 15, 25, whatever years ago. It's been a straight line. And that is actually a consequence of success, in the sense that the US-led trading system was very successful in developing economies of other places, maybe not quite so successful in helping the US continue to develop different problems. But elsewhere, quite successful. People were able to participate. Surprise, their economies grew. Surprise, the US relatively shrinks. So yes, China reoriented to everywhere else. So right at this very moment, I can't think of too many things that China needs from the US. That, I mean, and I can think, of course, of a lot of things that the US needs from China. So in the power politics game, shortages are different from losses. Losses you can sustain, shortages you can't. Shortages mean you have to do something differently, otherwise you just won't do it. Like there will be no Christmas in the United States this year because there will be no Christmas tree lights because you can't make them anywhere else. There's nowhere else with those factories. And then you have to build a factory. That's very different from saying, well, I'm going to have to buy my soybeans from somewhere else, but you know, I guess it's over to you, Brazil. Please don't raise the price too much. So that's a different kind of conversation. So I think China's basically said, well, suck it up, Buttercup. It's like, okay, this is not going to be fun. We should be prepared for some kind of turbulence and downturn, but yeah, we'll get through it. And just to close off on a controversial note, I take you back to 1959, or yeah, sorry, 1953. The China has just finished the World War II, sort of destroyed, completely disaster of an economy. 40 million people died during the war. What does it do as the world's poorest economy on the Korean border? It declares war against the world's richest country that has nuclear weapons. And it says, we're going to war. We're going to cross the border. We don't care. Admittedly, it was led by a genocidal maniac, narcissist. So that was a bit different. But nonetheless, one should not doubt the seriousness of the Chinese intent when they say they will not be bullied by the United States. This allows them to call back all of that nationalist mythology. And yes, I would not expect any particular I mean, they're not going to give in and to this kind of behavior. Now, are they open to deals? Yeah, but as I said, it takes a brave Chinese investor to do this. So let's see, what kind of a deal do we have? And yeah, let's, I hope we can come up with something, frankly, because yeah, this kind of war is not good for business.
But this will have its repercussions for sure, which we have started seeing kind of a situation globally when a lot of asset classes are behaving very differently. Be it, it's a slightly different question from what's happening to Chinese economy or US economy, but how are markets reacting to that in terms of be it US Treasury yield, be it US dollar movement, be it the hiding that the world is taking into the precious metals, and how the outlook on each of this is going to shape basis this. Do you have any insights to share in terms of China's investments in US Treasury, their outlook, their building up of their gold reserves? Do you have any insights and views on that?
Well, I think I'd probably defer to the folks like Jeetu or more like daily in the capital markets and yourself. But I mean, I think from the purpose of China's treasury holdings was simply the fact that you have a problem, you have too much cash. So, it is every year the Chinese economy generates savings equivalent to the GDP of the United Kingdom. So the whole thing. So
Yeah.
you have a tremendous amount of incremental cash building up. And now if you keep it at home, well, then you get asset price inflation, basically. And they've had a fair bit of that on the real estate side. So you say, I want to squash the asset price inflation. I want to sort of keep that stable. So where does it go? Well, I mean, I think naturally speaking, the treasuries were like viewed as at least, well, that's a relatively longer term, relatively safe environment. And so in the point of having money in a safe environment, long-term environment, is you don't move it out. So otherwise it was a bad decision. So we have to sort of assume that that bucket is still stable. Now, maybe it won't be
Okay.
great, but at least, so I don't see their desire to use that as a political weapon or anything else like that. That said, you now have a problem that every year you are generating savings equivalent to the GDP of the United Kingdom. So where do those go? And the answer is obviously anywhere else. So, I would expect that the biggest thing I could think of that this current situation drives is panda bonds. That there are sort of a lot of people out there who would be quite happy to issue RMB denominated debt for Chinese savers. And so this might be a good way to recycle that. And I mean, I'm out of my depth here, but that's what I see is that with the growth of the rise of the rest, that the Chinese ecosystem will expand to beyond China and the US. We'll just go to Saudi, and for all I know, it's in India. So, I mean, I think every place is different, but with the Belt and Road and sort of the globalization of the Chinese technology sector as well, there are enough capital investment opportunities, long-term capital investment opportunities outside of China to complete the circle, so that we can borrow and we can invest in RMB outside of China. Yeah, makes sense. So that would be my tip, such as it is.
And you were to share your presentation. Do you find any difficulty doing that?
No, I wasn't going to. I mean, I can present, but I like a conversation. So, but to the extent it's helpful, maybe I will give a few pages just on what drives the Chinese economy. Some colleagues might not have that in front
Perfect.
of their mind.
Perfect. While you're doing that, Jeetu, I would like to keep your question ready for her. And
Absolutely.
yes.
Absolutely.
All right, so this is publicly available information, just to be clear. It's not something that that I'm happy to provide it incidentally to folks who are interested, but it's not private or confidential. So that's so here's the Chinese economy in 10 numbers or 10 numbers and 5 graphics. So by April, for first 4 months, it's okay. 5 is fine. Yeah, 5.4% GDP growth. Median forecast somewhere at 4 to 5 range. That's where people are on the Chinese economy. If you go around and look, that's so the GDP growth is pretty solid. That is 60% driven by consumption. A big chunk, 30%, which is much higher than usual, by trade performance. I mean, I think this is a Q-on-Q number, so there's seasonal adjustment in there, and then 10% by fixed assets. So the macro economy is doing okay, largely consumption, some contribution from trade. Interesting if you look at production side, so production is up 6%, whereas floor space is down 1%. So the Chinese government is effective in strangling the real estate economy. This was intentional. That there was a point to this, that they do not want to see real estate and construction driving the investment side of the balance sheet. So in here, you've got a pretty flat on the fixed asset investment side of life, and production up. So utilization is going up in factories largely, but it's not the real estate investment particularly for residential, which is most of real estate investment, is flat to declining. If we look at the trade performance, which, as I said, was kind of unusually strong for exports. It's still, 6% export growth is pretty good. 10% was kind of crazy. But FDI down, so all the foreign direct investment off. So, but this is not a flashing red light. This is a mixed signal here. And it's still growing, just not as fast as it was before. And as you said, it's reorienting. It's reoriented continuously away from the US towards emerging markets for over a decade now, and I can show a few numbers on that. And then what is holding it up is retail and consumption. So retail sales growth up 4.5% versus 3.8, and CPI pretty flat. And China really watches CPI because that is the thing that will scare people to put even more money in the bank. So we're all waiting for the great Chinese consumer recovery. I think you're seeing it. I think this is what it looks like, as in you should not be thinking like 10% growth or something like that. 4.5 is good. 4.5 makes a lot of people a lot of money. And for their, point that there was a fairly robust round of finance, and this is what they call new social financing, was credit outflows. So, that was up a lot, but government revenues were down. So again, a mixed picture. The government is not collecting as much taxes, issuing a bit more debt, but not taking over the economy. If you were going to see something more dramatic, you would notice it. And very briefly, just to go through these with a few slides. So this is GDP growth. The black line is consumption, and as you can see, it kind of tweaks up there at the end. Trade is at a pretty high level relative to historically where it was. You have these weirdnesses back in 2022, but there's COVID. So and investment is a bit lower than it was before. So, but nothing that I would see as being particularly noteworthy here. What you do see, of course, historically, is the black line is consumption. This has been a consumption-led economy for quite some time now. The last decade or so, consumption has been driving all this growth. It's the highest thing on these charts. And trade goes up and trade goes down and trade goes up. So trade is quite volatile. And so I think that that's just a picture of where the Chinese GDP comes from. Targets going out. Yep, we will have more bonds, 4.5 trillion of those. We'll have about 5% GDP growth. This is the 2025 targets. CPI pretty flat. Continued, modest deficits, 3 or 4%. It's a boring economy. It's like, household income, same with GDP growth. Keep the credit consistent. We, have 12 million unemployed, employment rates. So, not a big amount of change. China's basically saying macro factors. This is what the government predicts. This is what they want to have happen. More or less keep it in place. Fixed asset investment. This is where we are. So it's the total is pretty flat here. What's below the line is real estate. So that was intentional. Again, the whole point. Let's keep it flat. And over here we see SOEs versus private sector. So the state has been goosing the economy a little bit through the SOEs. But remember that the state enterprises are the profitable ones. We're talking about China Telecom, China Railway, China Mobile. These are very profitable mega conglomerates who, and so yes, they're spending on infrastructure. So that's what that is. And the private sector is more or less the same. So it keeps going. It's pretty flat. Trade. Here we are on trade. So this is the line on exports. So you see the growth here, and whoop, that was up a bit. That was quite unusual. Who knows? Maybe people are stuffing the channel, sort of seeing that there's a chance to buy things. What's really happened in China, the trade story is the import collapse. So imports have collapsed over the last 3 years, and that's not really policy as much as it is simply consumer underperformance. So people putting money in the bank as opposed to buying stuff. And that all producers in China say that's a problem. And yeah, importers also. So this is, if you want an issue to sort of tackle, it's this. How do we get the Chinese consumer to spend more on anything, and in particular on imports, which would be great for India and for other places. Lastly, on the trade side, on exports, I mentioned reorientation. So this, as you said, this is the exports by region. So US is down there at 14, EU at 14, rest of Asia 33, ASEAN at 17, everything else. And yeah, US is like, okay, not falling off a cliff yet. It's 5%, but not growing by any means. And what's growing, of course, is ASEAN. So ASEAN is Southeast Asia is the big developer. Finally, on the savings, this is the consumer side. So there you go. That's the growth in deposit savings. China has a 35% savings rate. That's pretty wild compared to the US, which is down at 4%. And here you show, the increase in terms of the total versus retail sales or 2021's property sales. So the increase in savings was almost twice the total of retail sales in 2024. So there's a lot of money in the bank, and this can come out at any point in time, which is why predicting Chinese consumption trends is so difficult, because essentially it's about like, do I buy an apartment or do I put more money in the bank? And this is what's going on. They're buying a bit more of discretionary purchases. This would be, new Huawei phones or, new home appliances. So if you're in that business, you're good. Auto has been a bit flat in Q1. It's, that's a very complicated conversation about EVs and technology. No, but, pretty good. I wouldn't say there's a big difference here. Residential property market, as I said, the growth of floor space is way down. And so, yes, they're not buying apartments, at least. And this is what government is doing. So it's not a panic. Like in the COVID moments, you had some pretty significant sort of interventions. This is not that. This is more moderate kind of support for the economy. So yeah. All in all, I think an economy that's quite stable when it comes to this, and it's sort of driven by consumption, and it won't be that affected by this type of trade action, especially from a relatively minor trade partner.
Absolutely. Absolutely. This was useful to set the base again. And I will hand over to Jeetu to ask and take this conversation further.
Yeah, thank you, Lola. I thought that was really useful and interesting. And I remember, way back in my days of Capital, I used to produce these kind of things just to keep everyone tuned. Reminds me of those days again. But if we just fast forward to where we are today, and the whole battle that is going on between the US and China, when you talk to the smartest people over there, both in policy and in the corporate sector, what do you think you figure will happen? How will China react? And how are they going to take this forward?
Well, I think they've decided to step back from a bit. So, as in, they doubt that there is a credible counterparty. Simply put, they don't know who they can talk to. So, in the absence of having a counterparty to have a conversation with, you step back and you just wait for something to emerge. I think they'd all just, have a high degree of skepticism that the policy of the administration's policy will be consistent. They've seen it change before. Why wouldn't it change again? Even so, and who's the administration? It's not entirely clear. So that, I think, is it's in this context. So in the words of Stella Lee, who's the BYD country manager for North America, or region manager, she says, yes, it comes to electric vehicles. The U.S. is an interesting market, but it's very complicated. So, no, no,
Yeah.
we're just producing for Mexico. If somebody wants to drive it across the border, that's their problem, not mine. I have nothing to do with it. So, I think that's the attitude here. Essentially, it's like let's respect American borders. Like, fine, leave them to it, and then when something eventually emerges that looks like somebody that we can engage with, then okay, happy. I don't think China has anything against the US in that sense. And the US has been a good business and trade and technology partner, and US companies have made big investments in China, and they are invested in China, and they're quite successful in China for the most part. So no, and in fact, if I talk to my foreign invested enterprise colleagues in China, they're getting the full court press from local governments now to say, what can we do for you? How can we make your life better? Because please stay. And they're sort of concerned that these American companies and European companies even are getting pressure to pull back from China. And they're saying, no, don't go. You're a good taxpayer. Please stay. So, yeah, I mean, that's kind of the environment I see now.
And if you were to fast forward that and just see what some of the companies are doing on the ground, you hear stories about the rare earth suppliers, stopping supplies, permanent magnet suppliers, where they have the monopoly, essentially saying price is up 10 times, take it or leave it. Some of the active pharmaceutical ingredient suppliers holding customers to ransom. So essentially, I'm not sure how much of this is rehearsed together and how much of it is just individual companies. But do you hear chatter around that? As would that be a fair thing that continues, or is that just a short-term thing out there?
Well, I mean, there's a certain category of trade. When we did this analysis before, we looked at it and we said, okay, global trade, about 40% of global trade is what we can call concentrated trade, as in it occurs between less than 3 suppliers, or less than 3 suppliers provide most of the trade for this particular commodity. And within that, there's about 2/3 or 3/4 of that is like regionally concentrated. So it's like Ukraine to Lebanon for grain. It's like, yeah, I don't know why it happens, but that's the way it works. Whereas 10% of all global trade is concentrated trade, as in like there's one global supplier, globally concentrated. They do it all. So for China, that's largely the electronic sectors. So the value chain, but the whole value chain, including the processed magnets and the rare earths themselves, the reserves don't matter, it's not relevant. It's what you can do with it, because that takes quite a bit of effort to turn that into a high quality processed material that then has certain specifications that you can then use. So that is, that is part of the Chinese arsenal, if you will, of globally concentrated. When I say Chinese, I mean it just comes out of China. Now, the fact that it comes out of China and is globally concentrated means, of course, that you can use it as a weapon. You can put export controls on it. And China has done this before with neodymium and a few other things. And it's sort of like there was a big fight with Japan about a decade and a half ago. So yeah, it did that. And now it's done it again. And it's like, okay, so fine, you can do this. And I don't think it's out of any concern, particularly for their domestic economy. It's very clearly a tit for tat thing. And so, yeah, I mean, that's the way this game apparently is going to be played, because the US has done the same, of course. I mean, it's so like, we won't allow H2O chips from TSMC. We will, have embargoes on all kinds of AI related technologies, so yeah, here we go, back and back. And so, I mean, I think that's part of this game. Could China change its mind? Of course it could. I mean, I don't think on Japan, they pulled back and apologies were given and something happened and we all went back to normal here. I think that this is not normal. This is going to hurt value chains around the world, including in China. And an eye for an eye leaves us all blind. So, let's just see how far we want to go.
Do you have a crystal ball that either lays out how this impasse is solved, or do you see a reasonable probability of an accident in the next 3-6 months around this?
Oh, my crystal ball is as good as yours, Jeetu. I would say there's always a probability of an accident. That's what keeps us honest. Otherwise, we could keep playing this game forever. But we know that eventually our number will come up. And the question is, how badly do we want to crash the car? And we're right now running on adrenaline, and so I mean that's not I don't think this will go that long, frankly, because I do think that, as we saw, shipments are down and ports are starting to lay off truckers, and so this will become evident. The price of I forgot, there was an economist had something out there about all these home appliances and women's beauty products have gone up by 250%, all these very tiny little categories where somebody stocked out of it. And yeah, I mean, this is, again, I think the impetus, the desire, the first shots, if you want, were fired in the US. And the Chinese are sitting there saying, well, why should we change? What was in it? Why should we do this first? You guys went first. You should probably climb down first. So let's see how we go here. So
yeah.
So I will interrupt here for 1 minute and ask one question to both of you. In your considered view, do you think China's response of retaliatory tariff, keeping quiet and holding back on coming to table for negotiation, was anticipated by US? Or it has come as a little surprise? What is your view?
Well, I mean, for a long time, the China policy, or the China sort of desk, if you want, in the US, and it's actually pretty true for most places in the world, was a province of specialists. And, that simply put, there are not many people in Washington who speak Chinese and or have been to China. And so as a result, the desk is not well manned. And and manned, incidentally, not women. So that they're just simply a lack of like deep expertise,
Understand.
and I think that's inevitable to potentially not have the right view. Now, for all I know, there was perfect clarity about this, and this was the plan. In which case, interesting. I wonder what your longer term approach is going to be on this.
Yeah, actually, I agree, Amisha. I agree with what Lola just said. I think they underestimated the Chinese response and they overestimated their power, and that is where we've landed up.
And is what I hear from Lola's views that there will be many items where one of our person who is listening also says that US stores will go out of those items. It will start touching normal US citizens' lives, not only corporate profits. What some of these things do you think will bring them on table to a once again reconsidering the whole move against China? What is your view?
I mean, it's a good question. I mean, first of all, weren't we just here, 4 years ago? When the Chinese, factories went dark for 3 months, and all of a sudden everybody started to panic. And then, China got itself back online again. So that, and then everybody else's factories went dark. And then, China supplied the world, and Chinese export shares went bananas. China was like at 21% of global exports. It went to 25 in the course of a year. It's like, that's crazy. It's like, that doesn't usually happen. It's a very sticky number, but that's because everybody else fell down, basically. So, okay, so that we were just here. And if anybody remembers what it was like 4 years ago, you basically cut your consumption. And so, history and economic theory and practice both all tell us that what happens is demand destruction. That's what you get. When you put tariffs in, you get demand destruction. You don't get export rebounds, you get demand destruction. You get a fail on the risk on the consumer, takes it in the neck, and as a result, stops buying. So the answer to shortages is stay at home, don't buy it, let your hair grow long, don't go get a haircut, whatever. That is, and it's largely that. It's discretionary. I mean, we're not talking about things that you can't live without, but we are talking about pieces of the economy that will disappear. And then you will have to do the work to bring it back. So I think the problem here is what economists will call scarring, which is the aftermath of the impact, because it doesn't come back right away. The banks are more questioning. They don't want to lend as quickly. People are less entrepreneurial because they've run out of their savings. There's a lot of things. Bringing something back takes actual work, which then requires you to invest. So again, like, who's going to do that? We look at so fixed asset investments are down in the U.S. So we will take a reset and a rethink on the U.S. side to bring this back. And the further you go, the deeper the reset.
So, Lola, if I were to just take your point and say we've laid out the near-term picture and the challenges around that, but if we were to take a 5-year view and kind of think, how does this change the geopolitical architecture of the world, the trust levels in the key segments of the world, and what changes broadly from a 3, 4, 5-year perspective?
Well, I mean, I don't see dramatic changes in the sense that the secular long-term trends, as I said, the growth of the global economy is a consequence of success. Is that it's been quite good at mobilizing capital to be deployed into areas where you could invest it and make a productivity-based return. So, we did that. And now people have figured that out. So this will continue to happen. And so the title of my firm, Global 6, if they allow me, so there are 8 billion people on the planet. 2 billion of them are above what I would call the empowerment line, not the poverty line, but the line at which you have savings, roof over your head, decent job, some education. You can participate in society. And urban development and industrialization is a necessary step. That's how you get above the line, is by urbanizing and industrializing. That takes capital. So once you put capital in the ground in a way which can be logically deployed, which you can get, a decent return on it, then all this stuff can happen. There are 6 billion people on the planet who want that capital. There are 2 billion who have it. So the game here is about taking that capital and deploying it in those places in a way which is a, risk-based, whatever. But yes, it's about deploying it. And at this point, there is a tremendous amount of opportunity outside of the United States. There are plenty of opportunities in the US. And if you gave me the money, I'd love to invest in affordable housing in Los Angeles. But I would think that, the opportunities beyond the US are very compelling. And, there are now intermediaries and whether countries or corporations who are quite happy to help you deploy that kind of capital. So that's what I would see happening, is that we will continue to see that dimension play out. And you can see it in many ways. One of the more recent ones I've had a conversation about is what we call de-dollarization. And a lot of people think that de-dollarization is driven by a flight from the US dollar. And maybe so. Maybe there's something about that. I mean, that there's some, and it's more volatile and more inflationary, but basically the US dollar still has a lot of pluses. But why is it happening? Well, it's not because people are running away from something. They're running towards something. They're saying there is now more currencies. There are more economies. They will have their own currencies. Of course, if you are a Middle Eastern fund, you're probably going to be doing a little bit more in non-USD trade. So this, I think, is kind of the dynamic, is that will continue more or less unaffected. I mean, there is some collateral damage from the slowdown of a major driver of the global economy, which is the US consumer. But nonetheless, it will, if anything, accelerate the shift. And so, yes, that's how I would then translate that ultimately into, I'm not a geopolitical person, but yeah, it's hard to avoid the correlation between economic capabilities and currency and ultimately geopolitical throw weight, for lack of a better word.
Once again, I will come to each of you and ask, in this backdrop, how is India positioned to benefit in terms of positioning itself and capturing the trade which is being vacated both in US and in China also? What do you think? Is India doing right things? What more needs to be done? And how fast it needs to be done?
Jeetu, do you want to go first? I feel slightly vulnerable here.
Okay, no, so I have a strong view, but I've got a question for you, Lola, in a slightly different context around the same point. I'll come to that in a minute. First, let's try and answer Amisha's question. In my view, look, India is China's third largest customer. You got a US with a 300 billion surplus. You have Europe with just under 300 billion surplus, and you've got India with 100 billion surplus. So India is China's third largest customer, and there are dependencies, right, from a lot of different things in India, essentially made in China, and China can really make it difficult for India if you were to play a tough game. So my view is, if I was somewhere in policy in India, I would create better relationships, create better working relationships, try and bring this surplus down a bit, and try and benefit out of a mutually beneficial relationship. That's my humble opinion. Does India have less to supply to China than it needs, rather than the other way around? The answer is yes. Can you work towards rebalancing that a little bit? I'm sure. And that's my sense, that the world is changing. To point to my last question, US relevance is going down. US, a 30 trillion economy on a $110 trillion world. As the US dollar weakens over the next few years, Is the share of US going to go down? Yes. And in that world where US is less relevant and China is much more relevant, China probably goes up to a 20% or 25% of world output in 4 or 5 years. And you need to create a better relationship and work together. And both countries don't really go out and fight like some of the other guys do. So my view is you need to get a better relationship going, is my point. Lola, over to you.
Okay, well, I agree that, I mean, I think a better relationship will serve all parties for India versus the world. And so I think, like most players, they try to have it all ways. You know, we want good relationships with the US, want good relations with China, good relations with the Middle East, everybody, because it's in the interest of India. So, and I don't see any particular barrier to that, frankly. I think that at this point, India is kind of a variable for the US. And again, similar to China, there isn't a tremendous depth of expertise in Washington on this. But yeah, it's a variable. And if the US was engaged, I think they would really, serve the US well to strengthen its relationship with India and to sort of like create a special relationship, in fact, of some sort. That would be the smart thing to do if you want to play geopolitics for a moment. But in the absence of that, which I see no evidence of, then I think it's basically back to India to do what India needs. And, I think in that case, India, China, yeah, big relationship. If I'm India, I'm saying, well, okay, we're buying a lot of stuff. What are we getting for it? Where's the technology? Where's the R&D? And of course, India is, I think, one of the few countries that China has export controls on because China knows that India is a competitor. India is coming up in the world. And so, yeah, if you are, as I understand it, if you are a high-tech supplier to a major American telecom equipment company, if from China, no, you can't go to India. Government will tell you, no, you should not do that. It's not good for China. And it's a holding action because they know it's inevitable. It's not like this stuff won't go there. Of course it will. But yeah, I mean, India government should be pulling. It's like, let's get you guys in here. Let's have you educate a generation of Indian engineers so that then they can go off and be entrepreneurial and do their own thing. So the path India's on, I've seen it, my perspective before, as soon as you hit the 15 to 20% savings rate, you are now at the point where you can actually invest in your economy. And they hit that about 25 years after China did. So fine, we're on a fairly long-term path. It will continue to grow. We'll grow in a very Indian way, which means that it's not Chinese. It's not going to be like, one big plan and sort of let's all go run out and do it. And the Communist Party is standing behind everything. That's not India. So we will find, many varieties of development and growth in different places based on the local configurations. And I think a little bit of infrastructure would be a good thing. That would tend to lower the cost for all of us. And we don't have to sacrifice our independence or local oligopolistic behavior, but eventually we will, because yes, I mean, infrastructure means competition. So, but yeah, I mean, I think the relationships vis-a-vis China should be based on the principles of mutual development and benefit. And India should demand China contribute to the Indian economy as its third largest economy. Of course you should. And it's like, what? Well, obviously you should. So, yeah, I feel like maybe India could be even a little bit more direct in that regard.
Slightly more differentiated question on these itself is that when COVID hit, China plus one term got coined, and world as well as India was very hopeful that India will get some proportionate share either of FDI or of technology and in turn of manufacturing and trade. But that entirely went past India largely, and it went to Vietnam, Bangladesh, so on and so forth. Do you think this time round we will see India catching up? And will this be a moment for India, even if for US exports to, Chinese exports to US is less in Chinese economy's terms, but if a part of it comes for India to export to US, it could be big for India because we are still relatively very small. Is that likely to happen?
I'd love to, again, hear what you have to say, Jeetu, but I have a view in a sense that, I mean, to be part of the global manufacturing export, I mean, India made its mark on this IT outsourcing, and so that was a thing, and I believe there's more there, could continue, but if we stick on the manufactured side of life, you need a workforce, you need reliable infrastructure, you need access to water. That's what you need. So as long as you have those three things, then you can do it. And unfortunately in India, well, I think we've sort of had the workforce, but it's been, patchy some places. We have coastal. We've sort of fallen down on the infrastructure side a little bit, that we just don't, and by infrastructure, I include the factory. So you got to have scale. And the problem with this is that infrastructure and factories come in large stochastic chunks. It's not like you can build half a terminal or half a pier. I mean, you can try, but it doesn't go very well. So what you need then is a big chunk of money. And that chunk of money is usually beyond the capacity of the local government or the family group to do. So you need a sovereign. You need some kind of a government to stand there. And here's the problem: India's too big. So you have the sovereign of India, standing at a great height, and then you have the need to put, a port together, and that mix and match. There's a long way between the center and the local, and a lot of people get in the way of that, and there's not a lot of trust. So if you try to lend as the Chase Manhattan or the AIIB or the whoever to a subnational authority, you want some kind of security. And you're not going to get that in India. So, I mean, you have to be very bold and brave to do that. So what instead you get, instead of getting the big brand new port and big piece of infrastructure, which is what characterizes London, the development of the US, China, you oversize these things, you get kind of incremental creep, which is just not as good. And so I think a large portion of this is just like, we couldn't get the trust, the capacity to believe that India can do it at scale early enough so we could build this stuff to take advantage of it. And what did? Vietnam, Bangladesh, Cambodia. And you ask, like, why did those places do it? Why, and not us? You say, well, a government stood behind it. The sovereign gave guarantees. The sovereign said, yes, we are going to guarantee this project. And then it gets built because, essentially it's treasury money. So I know there are ways of doing it, but that's my interpretation of, like, you have to do that. And frankly, India was much more domestically oriented. Just like, no, we're not going to go there. We'll do the domestic stuff first. I don't know, Jeetu, did that resonate? I'm curious.
No, I agree with you, but on the positive side of this, the GCC architecture that's being built in India, couple of thousand large companies globally have using over 2 million Indian bodies to create their backends, and the numbers are at about 100 billion today of services being provided worldwide, and I think that number in 4 or 5 years doubles. So in my view, what you're creating a manufacturing infrastructure in China, you're creating a soft infrastructure in India for the softer side of it, and that is as critical as the hard side. And I think that's a very useful thing. While doing that, they should do exactly what you say as well. So I don't disagree.
Yeah, that's a great point.
Can I, Lola, just a point I'd love if a few large Indian companies come in as a client to you and say, what advice would you give them in the light of the current issues and the light of the current situation? Would you advise them something that might be valuable to them? I'm kind of using you've got a China inside, you have a US inside, and a unique axis around that, and there's something that people in India might benefit from that insights of this axis.
Well, I first of all think that India, as well as the other sort of set of globalizing economies, are very well placed at this moment. That one should have a bit of confidence. The historic, and if the concern is about, what rules are they? Well, fair enough, but then it's up to oneself to define what kind of rules do you want and start engaging in them. So, but in generally speaking, I don't think that the absence of rules is going to be much of a deterrent. People are used to dealing in chaotic situations at home. What's different? Sort of, you just have to do your diligence and find your partners and be careful about your development. But right now, we have never been developing as fast as we have globally. There have never been more people coming to markets. And these people look a lot like Indians. So, as in, they have the same income levels, they have the same, socioeconomic backgrounds, they almost have the same demographics. And so, like, yeah, products and services that are developed in India for the global markets could be quite appropriate. And then there are more options. Like we now, instead of before, like, okay, you partner with GE, that's it. And kind of do that, get Bangalore going. Now you can do, GE or Huawei. Plus, I don't know, maybe there's a Brazilian, maybe the PIF is interested. Who knows what's going on? There's lots of options here. And that should also be a thing, but open up your horizons. Think about this, because now is an opportunity. There is a window before whatever the next sort of moment of stasis sets in to get some territory, to grab some land in the markets and the technologies and the talent bases of the next generation. And the funny thing, we know where it's going to be. It's not like it's a secret. We know that the Middle East will have 1 billion people by 2100. It's not that this is a secret. So like you can just go look at the demographics. We know Africa will have 2 billion people by 2100. So I mean, of course, Africa is a huge disparate continent, but we know that that's where opportunity is, and we know that capital is not going to run away from either the U.S. or Europe. There will be pools of capital there, and frankly, they're going to need technologies and services that are more fit for purpose, as in cheaper than they've had in the past. So I think that there will be, if I look at the US healthcare system, one of the fastest growing things is urgent care. There's a reason. So, I mean, as in the median income needs that. That's what they need right now. So, I mean, I feel like there are plenty of opportunities for a place like India, which has, for lack of a better term, neutrality. It's not India, it's not US, it's not China, to engage in all the territories. And they should play that to its maximum benefit of India and of Indian companies.
Thank you so much, Lola. But one question comes back to you, Jeetu. What's your view on global equity markets, Indian equity markets, dollar and gold? And what would you advise all the investors who are listening to you?
Well, we're in the middle of a disequilibrium right now. We came from an old equilibrium, which was sort of stable. And then in the last few months, things started changing. We're right now in the middle of a disequilibrium. The one old rule that I kind of believe is that markets will always stay nervous in disequilibrium, right? So when you're saying disequilibrium, it could mean economic disequilibrium, it could mean business disequilibrium, it could mean consumer behavioral disequilibrium. My sense is this creates a fair amount of nervousness in my mind of what I think markets would be doing. It's not about India, or US, or Europe, or China. It's just about markets in general. Because now, do you kind of move from this disequilibrium to a new equilibrium, maybe 6 months, 9 months, 12 months, 18 months? Yes. The new equilibrium will have certain winners and losers. There will be casualties. And going through this uncertainty, in my view, is not going to be easy. You need a fair amount of policy support, and you need a lot of what I'd say, really smart thinking to navigate the next 6 or 9 months. So while laying out the landscape, I'm kind of saying I'm nervous for markets purely because we're going through a period of disequilibrium. I'm not saying I'm very negative or I'm very positive. I'm just saying I'm nervous because I don't know what the outcome is. Once we set a new equilibrium, and which was my question to Lola, what's the new equilibrium going to look like? Can you crystal ball gaze? What are the Chinese going to do? How do we come out of this? Once that new equilibrium is set, I think we can start repricing markets with greater confidence. Are we there yet? Answer is no. In the interim, what do I see in my understanding? I think a lot of this battle is for funding the US deficits. My understanding, US needs to fund about 8 trillion of paper this year, which is rollovers from the last few years plus this year's deficit. Is that a battle for the Treasury team? Absolutely. Does it get funded? Reasonable chance. Does the Fed have to fiscal monetize? I think a fair part of it. What are the implications of that? A weaker dollar. What do I see? Euro dollar 120, 125 year end. I see dollar yen weakening, and I see EM currency strengthening. Gold in that environment will do well. So I think that's a quick summary of what I believe all around the world. I think India's not really going to be an exception to this entire story. I think it's the best pin code in the world to be in, to navigate this global disequilibrium, both from a business standpoint as well as a stability standpoint. It's probably the best pin code. But when a tsunami comes, and if a tsunami comes, the best pin code is vulnerable too. That's it for me.
Very well summarized. Lola, would you like to add something to this?
No, I respect the opinion. It makes sense to me. And yeah, no, I think we have interesting moments, but we say in China, every crisis is an opportunity. So, we should look for that.
And we would be looking forward to catch you in person when you are in India.
Yeah, I would look forward to that. It'd be great. I hope to do so. I have aspirations and they said prior. So yes, let's work together.
Thank
I'll
you
reach
so
out to
much.
you when I'm in China in a couple of weeks, Lola.
Wonderful. Look forward to that. I'll be here. Okay.
Thank you so much, both of you. Lola, your time allotted to us is done. That's why I'm not taking audience questions. But I think it was a very, very insightful discussion. And I must say, you made it so simple, going by how the human psychology works. And you just de-jargonized the whole conversation, made it very easy.
Okay.
For everyone to
Thank you. I appreciate that.
And Jeetu, you added not only the right questions, but also you gave replies to some of the most important questions from investor perspective. So thank you so much for being part of this.
Thank you, Amisha, for kindly inviting me and for being on the panel. Thank you.
Thank you so much, both of you. Thank you.
Okay. See you next time.
Yes.
Bye.
Bye.